Trump's tariff plan, can it really replace income tax, and how will it affect your finances? In a world where economic uncertainty looms large, one question echoes through the corridors of power. Can tariffs replace income tax? The proposal, floated by former President Donald Trump, has sparked intense debate and raised fundamental questions about the very fabric of our economic system. As the U.S. grapples with a soaring national debt and a complex web of international trade agreements, the stakes have never been higher. Will Trump's tariff plan prove to be a masterstroke of economic genius or a recipe for disaster? As we delve into the intricacies of this proposal, one thing is clear. The fate of the U.S. economy hangs precariously in the balance. In this video, we'll take a deep dive into the world of tariffs and income tax, exploring the implications of Trump's plan and what it could mean for your finances, your family, and your future. So join us on this journey into the heart of the U.S. economy, where the lines between politics, policy, and prosperity are constantly blurred. Understanding tariffs and income tax. To grasp the implications of Trump's tariff plan, it's essential to understand the fundamentals of tariffs and income tax. Tariffs are taxes imposed on imported goods and services, typically expressed as a percentage of the import value. They can be used to protect domestic industries, raise revenue, or retaliate against other countries' trade practices. In contrast, income tax is a direct tax levied on an individual's or business's income, typically used to fund public goods and services. The U.S. has a progressive income tax system, where higher income earners are taxed at a higher rate. Tariffs and income tax have distinct economic effects. Tariffs can influence trade flows, prices, and consumption patterns, while income tax affects the disposable income, savings, and investment decisions. Understanding these differences is crucial in evaluating Trump's proposal to replace income tax with tariffs, as it would require a fundamental shift in how the U.S. generates revenue and conducts trade. Trump's tariff plan explained. Trump's tariff plan, as proposed, aims to replace the current income tax system with a tariff-based revenue model. The plan involves imposing tariffs on imported goods and services, with rates varying depending on the country of origin and the type of product. The proposed tariffs would be designed to generate revenue equivalent to the current income tax receipts, approximately $1.7 trillion annually. Trump's plan also suggests that the tariffs would be levied on a broader range of imported goods, including those from countries with which the U.S. has trade agreements. Additionally, the plan proposes a border adjustment tax, which would tax imports at a rate of 20% and exempt exports from taxation. The goal of this plan is to encourage domestic production, create jobs, and reduce the trade deficit. However, critics argue that the plan would lead to higher prices for consumers, spark trade wars, and harm U.S. businesses that rely on imports. Can tariffs replace income tax? Replacing income tax with tariffs is a highly complex and contentious issue. While tariffs can generate significant revenue, they are not a reliable or sustainable substitute for income tax. One major concern is that tariffs would disproportionately affect low and middle-income households, who spend a larger portion of their income on imported goods. This could lead to higher prices, reduced consumer purchasing power, and increased economic inequality. Furthermore, tariffs would not address the underlying issues of tax evasion, tax avoidance, and income inequality that plague the current tax system. Additionally, relying on tariffs as a primary source of revenue would make the U.S. economy vulnerable to fluctuations in global trade and market conditions. Experts also argue that tariffs would not provide the same level of progressivity as income tax, where higher income earners are taxed at a higher rate. Overall, while tariffs can be a useful tool for trade policy, they are not a viable replacement for income tax. Impact on household finances. The impact of Trump's tariff plan on household finances would be far-reaching and multifaceted. With tariffs imposed on a wide range of imported goods, consumers would likely face higher prices on everyday items such as food, clothing, and electronics. This could lead to a decrease in purchasing power, particularly for low and middle-income households. Additionally, the tariffs could also affect the cost of raw materials and intermediate goods, leading to higher production costs and potentially even higher prices for domestically produced goods. Furthermore, the tariffs could also impact the availability of certain goods, leading to shortages and further disruptions to household finances. As a result, households would need to adjust their budgets and spending habits to accommodate the changes, potentially leading to a decrease in consumer spending and economic activity. Economic consequences and criticisms. Trump's tariff plan has been met with widespread criticism from economists, trade experts, and business leaders. One of the primary concerns is that the tariffs would spark a trade war, leading to retaliatory measures from other countries and potentially devastating consequences for U.S. exports. This could result in significant job losses, particularly in industries that rely heavily on international trade. Additionally, the tariffs would likely lead to higher production costs, reduced competitiveness, and decreased economic efficiency. Critics also argue that the tariffs would disproportionately harm small businesses and low-income households, who would struggle to absorb the increased costs. Furthermore, the tariffs would undermine the rules-based international trading system, potentially leading to a breakdown in global trade relations. Many experts believe that the tariffs would ultimately harm the U.S. economy rather than helping it, and that alternative solutions, such as tax reform and investment in education and infrastructure, would be more effective in promoting economic growth and competitiveness. Alternative solutions and recommendations. Rather than relying on tariffs, experts recommend exploring alternative solutions to address the U.S. trade deficit and promote economic growth. One approach is to invest in education and workforce development, enabling American workers to compete more effectively in the global economy. Additionally, investing in infrastructure, such as roads, bridges, and public transportation, could help to increase productivity and competitiveness. Tax reform is another critical area, with many experts advocating for a more streamlined and efficient tax code that encourages investment and innovation. Furthermore, promoting free trade agreements and strengthening international trade relationships could help to increase U.S. exports and reduce the trade deficit. Some experts also suggest implementing a border carbon adjustment, which would tax imports based on their carbon content to encourage more sustainable trade practices. By pursuing these alternative solutions, the U.S. can promote economic growth, reduce the trade deficit, and increase competitiveness without resorting to tariffs. Conclusion and final thoughts. In conclusion, Trump's tariff plan to replace income tax is a complex and contentious issue. While the plan aims to promote domestic production and reduce the trade deficit, it is unlikely to achieve its intended goals and may even harm the U.S. economy. The tariffs would disproportionately affect low and middle-income households, lead to higher prices, and potentially spark a trade war. Instead, the U.S. should focus on alternative solutions, such as investing in education and infrastructure, promoting free trade agreements, and reforming the tax code. By pursuing these solutions, the U.S. can promote economic growth, reduce the trade deficit, and increase competitiveness. As we move forward, it is essential to have a nuanced and informed discussion about the future of U.S. trade and tax policy. By working together, we can create a more prosperous and sustainable economic future for all Americans. Thank you for watching the video. Please subscribe our channel for more interesting videos.